let's talk about how you can actually use the money in your insurance, because I understand that's possible. I don't know the breakdown. People say if you have a lot of money, you can put a lot of money in up front, and IUL, and what's the other one? VUL. And the difference is, we had a conversation downstairs, that was the battle, IUL versus VUL. So you're putting money into a whole life right now.
Are you talking about VUL, IUL, or whole life?
Okay, so let me back all the way up to the types of life insurance.
Okay.
We got the term down.
Got that
right?
down.
It ends. You can't take no money out of term.
Nothing.
Right. So term's over here. Then you got whole life. But there's different types.
Under the permanent insurance umbrella.
Under the permanent insurance umbrella is whole life.
Yes.
Okay. Whole life is you pay forever.
Not necessarily.
That's a question mark.
Okay.
Well, then respond to that.
Okay, so whole life, just like you have universal life, right, under the permanent insurance umbrella, there are many variations of it. So you have whole life policies that you could pay to age 100. You can customize it where it's a 10 pay. You only pay for 10 years. You can have single pay. You can do 20 pay, 15, 5, 6, whatever. Depending on the company, you can do any pay up to 30 years. In addition to that, you can also pay to a certain age. There's policies to age 65, to 85, 100, 121. The thing about it is, the shorter the pay period, the more money it's going to cost, the more cash value it's going to build, the fastest. Okay? So if you're looking to build your cash value fast, you're going to take a shorter pay period, and you're also going to have a higher death benefit. Okay? That's how you're going to build that cash value the fastest.
And you would do that why?
So if you want to use the cash value, then you're going to want to build it fast, because some people are looking to
but if you have money, you already have money.
Okay.
So why are you putting a lot of money into life insurance just to use that money? What is the benefit?
Two ways. One way, it's going to get the compound interest, so it's going to build you money. But the second way is, when you die, it's going to pay out in a death benefit, but it's going to leverage. So you might have put $100K in here, but that might have brought you a $1.5 million death benefit. So where are we getting that kind of return immediately?
Okay.
Tax free.
So let me move this back. So are you saying if you put a lot of money up front, right, you could borrow a portion of that money from yourself?
Absolutely.
You could use that money to make more money, but that full amount is still in there giving you interest? Is that what you're saying?
Depending on the type of company, if it's direct or non-direct, yes.